I am Andy Kim from SKKU in Seoul, Korea, and I would like to briefly explain how the lunch will proceed this afternoon. I mean, the keynote speech, and then Professor Hee-jun An, the president of Korea Security Association, will have a welcoming address. Then Professor Kwang-woo Park, the program chair of CAFM 2020, will introduce the keynote speaker, Professor Heitor Almeida from the University of Illinois, Urbana-Champaign. For those of you who would like to ask questions to the keynote speaker, you have two ways to do so. If you're watching it via Zoom, you can always write down your questions through the chatting function. If you are on site over here in Joseon Hotel, then you could write down your questions on a piece of paper and give it to me as our administrator would circulate the papers around your tables. Or also we could circulate a microphone, but it's your choice. And please identify yourself by saying your name and institutions you work for. Now, ladies and gentlemen, please welcome Professor Hee-jun An as he comes to the podium. He is the professor of finance at SKKU, my boss. And he is the current president of KSA. Please give him a big hand.
Ladies and gentlemen, good afternoon, good evening, and good morning. This year's conference is special because you are participating from all corners of the globe. For some of you, I believe it is well past midnight there. Regardless of where you are and what time it is there, I'd like to truly welcome each and every one of you to this year's conference on Asia-Pacific financial markets, hosted by the Korean Securities Association. It is my great pleasure and honor to give this welcoming address here on behalf of the association. I am very pleased that you are here in this year's conference as a chairperson, presenter, discussant, and just audience. I wish all of you are enjoying a great experience with every minute of the conference. The KSA started this special event 15 years ago, back in 2006, then hosted by our 23rd president of the association, Professor Hyuk Choi of Seoul National University, to commemorate the inclusion of our flagship journal, the Asia-Pacific Journal of Financial Studies, in the SSCI Index, the first such journal in finance in the Asia-Pacific region. For the past 15 years, the conference has evolved into one of the most successful and influential conferences in the region in finance, with so many top quality papers and presented by internationally diverse population of researchers, with many of the papers eventually making their way to top journal publications. This year, we entered another important chapter in the history of the conference. With the global pandemic rampaging the world, we could not but go online for most of the paper presentations, taking a hybrid form of a conference. We have had a lot of challenges and difficulties in the process, almost in every stage of conference preparation. However, in some way, the challenge turned out to be a blessing. This year, we had the largest number of paper submissions in the history of the conference. An improvement is seen not just in terms of quantity, but also in terms of quality. It is evident from many of the papers presented, the overall quality of the conference further improved by a significant measure. I hope this improving trend continues further next year and onward, even after we get back to normalcy and hold an on-site conference. I will close my talk with my gratitude to all who contributed to this wonderful conference. First of all, I thank all the participants who make this conference a truly wonderful event. I give my sincere appreciation to Professor Heitor Almeida, who will give his keynote speech shortly. To Professor Lilian Ng, who gave her guest lecture yesterday, and to Dr. Seok-Hun Yoon, the governor of the Financial Supervisory Service, who will give his keynote address during the award ceremony later this evening. The conference may not have been possible without the generous support by our 12 sponsoring institutions. I give each one of them my deepest gratitude. Last but not least, I extend my gratitude to the members of the Conference Program Committee, including the Program Chair, Professor Kwang-woo Park, for their dedication during the past 9 months to make this conference successful. You are truly a dedicated elite team. By the way, I do not have the information about who will get the 8 Best Paper Awards along with 2 Best Doctoral Paper Awards. We have intentionally kept this information highly confidential. Even most of the conference insiders do not know this, including myself. You will only be able to find it out during the award ceremony, which is the final event of the conference. So please stay with us until the end of the conference. I hope you all enjoy the rest of the conference. I will see you in the evening at 5:30 Seoul time, PM, of course, at the award ceremony. Well, is that 3:30 a.m. Eastern time? That means for those who are there, you are not going to bed tonight. Okay, thank you.
Thank you for your great speech, Professor An. Now, Professor Kwang-woo Park, the program chair of CAFM 2020, will come to the podium and introduce our keynote speaker to you. Professor Park is the head of the Graduate School of Finance at KAIST in Seoul, Korea, and he is the president-elect of KSA. Ladies and gentlemen, please give him a great applause, please.
Thanks, Andy, and thanks all for the dedicated service by our program committee members. It is a great privilege to introduce Professor Heiter Armeider, the Stanley and Joanne Gold Chair Professor at University of Illinois at Urbana-Champaign. He's the incoming editor-in-chief of the Journal of Corporate Finance. He's been serving as a research fellow of National Bureau of Economic Research since 2002. Prior to joining University of Illinois, he was tenured professor at NYU Stern School. Heiter has received numerous awards, including winner of the Journal of Finance Breton Prize and the Jensen Prize of the Journal of Financial Economics, and has received more than 14,000 Google citations. Heiter received his PhD in economics at the University of Chicago. We regret that we can't see physically Professor Armeider here, but I will surely let our future program committee members to invite Professor Armeider again in the near future when the pandemic goes away. Would you welcome Professor Armeider?
Good evening. I want to start by thanking the organizers for inviting me to give this talk, share some thoughts about the impact of COVID-19 on corporations. And, unfortunately, I can't be in Korea because of the pandemic, but I'm happy I can share some ideas in this through this video, right? Online is what we've been doing since March. So this is my talk focuses mostly on liquidity management, which is a topic that I have been studying in my research since the beginning of my career. And it turns out that COVID-19 was a really great example of how important liquidity management is to the economy, to the corporate sector. And this is going to be the main thing I'm going to talk about. But let me start by just comparing the two recent crises that we have had here in the US, at least, and in Europe, right? The first, the 2007-2009 financial crisis, which, as we know, started in the household sector, right? Was a crisis that was caused by declining housing prices. Then it hit household finances, right? And then it had significant impact on banks. The corporate sector, though, was only indirectly affected, right? So it wasn't a crisis that directly affected corporate cash flows. In contrast, COVID-19 is a direct shock to non-financial, right? The corporate cash flows and balance sheets. And because of this, the responses that we saw, both from the corporate sector and from the US government and other governments around the world as well, are fairly different. And this is what I'm going to try to talk to you about, is just show you the magnitude of the liquidity crisis, and then talk about how corporations and governments responded by running for liquidity, and then the government trying to help companies access this liquidity, and then talk about some challenges ahead, right? So what's going to happen, just try to speculate about what's going to happen in the upcoming months. I think, as you're probably seeing, the data from financial markets, I think it's pretty good news. We're probably going to be out of this crisis very soon. And then at the end, I'm going to try to go back to the research about liquidity management and talk a bit about what I think are possibly some open research questions that are really have been raised by what happened during this year, during COVID-19. I think some interesting things for research to think about going forward. So let me start here by showing you the magnitude of the COVID-19 shock to profits during 2020. So this is a chart that comes from Standard & Poor's. It shows you the earnings forecasts for companies in the S&P 500. And these are rolling forecasts. They are taken in different periods of time. So I want you to focus here at the end at the graph. I'm highlighting it here. So this blue line that you see here is are the earnings forecasts as of February of 2020. So as early as February, analysts expected profits to keep growing as they were growing before, right? And then, of course, in March, what happened is the lockdown started, right? We realized that COVID-19 was going to have a major impact on the economy. And then you can see here that the starting in May, so you have a forecast at the bottom here, earnings forecasts for the S&P 500 companies taken in 3 periods of time, May of 2020, August, and November of 2020. And you can see that essentially what this is showing is corporate profits during 2020 are going to be significantly lower than expected, right? This is what the S&P is calling an earnings recession, right? There's a huge drop in profits in 2020. And then the other point that this figure shows is that analysts expect profits to pick up in 2021. So COVID-19 is expected to be a temporary shock to corporate profits in 2020, but there is a robust recovery for earnings projected for 2021. This was the case in May, in August, and in November, which is the red line here, the most recent forecast. It's pretty consistent. There's some changes, right? So in August, you can see that the forecasts were a little more pessimistic, and then now but it's a very consistent picture, right? Which essentially there's this large negative shock to corporate profits in 2020, and a recovering profit growth expected for 2021. So the question is, what should companies do in this scenario? And what I'm going to do is actually to use an example of a specific company that was hit very hard by COVID-19. If you have visited the US, you probably know this restaurant. It's called the Ruth's Chris Steakhouse. It's owned by a company called Ruth's Hospitality Group. As you know, this is a high-end restaurant that focuses on indoor dining. Here, there are some outdoor tables you can see. This picture comes from the Charlotte, North Carolina branch. But you know, Ruth's mostly serves steaks in an indoor setting, not very conducive for takeout. So you know, it's a company that we expect to be heavily hit by COVID-19, and it was. So here are the profit forecasts for Ruth's Hospitality Group. The EBITDA in 2019 was about $75 million. And for 2020, as of November, EBITDA is expected to go down to about 9 million. So you can see the magnitude of the decline in profits. As we consistent with the S&P 500 forecast, Ruth's Hospitality Group expects profits to go back up in 2021 and 22. So these are essentially the analyst EBITDA forecasts that we have now. Okay, so what should Ruth's do? I mean, is this a problem, right? Is this liquidity shock? I mean, it's not necessarily a liquidity shock, by the way. It's a shock to profits. But the problem is companies have bills to pay, right? In the case of Ruth's, for example, they had a short-term liabilities of about $60 million for 2020, including accounts payable, debt payments that they had to make, etc. So, and they only had $5 million in cash at the beginning of 2020. So essentially, they don't have enough money, right? They need to raise cash. Okay. And one point that we know from corporate finance research, it's pretty obvious, I think, but it's good to point out that short-term financing is not going to solve the problem, right? So if Ruth's Chris had issued a short-term loan that was due in 2020, that's really not going to solve the liquidity problem because you have to repay the loan very soon, right before profits pick up. So what companies need to do at this point is to issue long-term finance, right? So either debt or maybe issuing equity, right? However, what we know from corporate finance research is that at least in the US and in other places in the world as well, companies typically avoid issuing equity, right? And that's especially the case when stock prices are low in March and April, right? When the COVID-19 shock hit, stock prices declined significantly. So it wasn't a great time to issue equity. What US companies did is they went for long-term debt. So US companies, the demand for long-term debt increased a lot as a way of responding to this liquidity shock, the uncertainty associated with COVID-19. And then, of course, the two sources of long-term debt that companies use are mostly bank loans and bonds, right? Essentially, those two. So what Ruth's did in particular is to issue new long-term debt in March of 2020. So Ruth's issued $85 million in new long-term debt that is due later, right? And held the proceeds as cash balances. So the cash holdings in the company went up from $5 million to $71 million in March. Okay. So here's the strategy as I see it. This is the this is the liquidity management strategy that companies employed during COVID-19, right? So we are today here in 2020, we are hit with a negative cash flow shock, right? So the companies have bills to pay, they have to increase liquidity. What they did is borrow long-term, issuing long-term debt, and holding the proceeds as cash balances. And then, of course, the expectation is that when tomorrow comes, right? So when 2021, 22, of course, company is going to have to repay the debt, right? But by then, the crisis is over and profits are going to go back up. So the company is not going to have problems repaying debt. Okay, so in the meantime, the cash that the company holds is going to increase the company's financial flexibility. Ruth's can use this cash to pay bills. Okay, Let me point out. I mean, it seems like an obvious thing to do, but the interesting point here is that as you can see, Roof is increasing financial flexibility by issuing debt, right? So the company is becoming more highly levered. And in corporate finance, there is this alternative idea that the best way to preserve financial flexibility is to have low debt. And this is a point that we made in our 2007 paper on cash and negative debt. This is a paper I wrote with Viral Achar and Murilo Campelo. What we call this strategy precautionary borrowing, right? So really what Roof did is to engage in precautionary borrowing, issuing long-term debt to hold cash balances can increase the company's financial flexibility. So this is a better liquidity management strategy than to keep, than to try to keep that capacity, right, for the future. So this is what Roofs did, and as we're going to see, this is the case for U.S. companies as a whole. One problem, though, is that we have to think about the markets, right? So companies have this demand for long-term debt, this demand for precautionary borrowing, but debt markets were virtually shut down in the beginning of March 2020. So let me just show you a chart to illustrate this. This is a chart that shows the prices of leverage loans. So these are bank loans that are made for highly levered companies, and these trade in the market, so we can get data on prices. In the beginning of 2020, these loans were trading at about $97 dollars per face value, right? So I've done a calculation here just to show you the magnitude of the increase in interest rates that is implied by the decline in prices. Of course, this is not a precise. It depends. The specific calculation depends on maturity and other variables, but this is an approximation. You can see that the implied interest rate went up almost 3 times. So it was 3.8%, and it went up to 11% in the beginning of 2020. So the interest rates shot up through the roof, right? So, and as we know already from corporate finance research, having this really high interest rate in the market doesn't mean that companies can borrow. Even if you're willing to pay, the bank might deny you the loan, right? Because this raises the concerns about adverse selection. Only bad companies are willing to borrow at these super high interest rates. So essentially, we can think of the situation as a situation in which debt markets were virtually shut down. So what U.S. companies did is they relied on existing credit lines. Okay, so it was a very good example of how useful credit lines are for liquidity management. So the advantage of a credit line, as we have shown in a previous research in corporate finance, including some of my papers, is that if you have a credit line, the loan terms are predetermined, including the interest rate and the maximum amount that companies can draw down, right? So in the case of Roofs, for example, this is an excerpt from the company's 10K. Essentially what they did is they drew on their existing credit line on March 16, 2020. They decided to draw down on the remaining amount of 51.2. It's about $55 million. Okay, and notice the interest rate. It's only 2.74%. So this is a time at which bank loans were being made, if any, at like 11%, 12%. But because Roofs had access to a credit line, they were able to borrow at 2.74%. Okay, this is an example of credit lines as liquidity insurance, right? So essentially, the role of credit lines for corporate finance. Of course, the access to credit lines is not free, right? Companies pay for this insurance through the commitment fees, right? So, for example, in the case of Roofs, if they had a credit line of $60 million, they would be paying an annual fee of I don't have the exact data here, but typically it varies from 0.25 to 0.75% every year to keep the credit line open. So what I like to tell my students when I teach the credit lines, that it's a mix of a corporate credit card, right, that you can use at any time, but that also has insurance. Credit cards in the US have very high interest rates, but the credit line has this interest rate and borrowing insurance that it can be very useful for companies. And roof squeeze is not, it's not the only case. There is clear evidence that U.S. companies heavily relied on their credit lines in March and April to increase liquidity. So this is a chart coming from a very nice paper by my co-author Viro Achari and Sasha Stefan at Frankfurt, showing the cumulative drawdowns by U.S. companies in March and April of 2020. That was the worst period, right, for the COVID-19 crisis here. And you can see that U.S. companies drew down more than $300 billion from their bank credit lines in order to increase liquidity, right? And this kind of bottoms out after April. So really, it was a rush to credit lines that happened here during March and April. Okay, here are some of the names, right? Just to put more names into the picture. Roofs is not here because now we're looking at bigger companies, but you can see that the usual suspects are here: airlines, right? Companies that were heavily hit by the COVID-19 shock. Hotels like Marriott, cruise companies, they all ran to increase liquidity using their credit lines. Okay, so that's something that companies definitely did. What though if there is no credit line, right? So not all companies are going to have access to sufficient pre-committed financing. Perhaps you had a credit line that you used already, right? Or maybe you didn't have a credit line. So that's a problem. And then there were also concerns at that time that these drawdowns were going to stress the banking system, right? So we have to think about the side of the bank, which is something I'm going to talk about in the end. Credit lines were not going to solve the liquidity problem that the economy had. So that's how I think there's a good way to understand what the U.S. government did during this period. So the set of Fed Treasury policies that the U.S. government put together is a way of providing liquidity to debt markets. Clearly, there was this demand from the corporate side. The U.S. government saw this and was concerned about banks as well, right? And then what the government did is step in to provide liquidity, essentially fulfilling the lender of last resort role that the government plays during crises like this. So I'm not going to talk about the policies in detail. Just to give you an introduction, there is a very nice webinar by Jeremy Stein that I'm citing at the end. You can have a look to have more details. It's easy to read about this as well. But essentially, just to give you the broad picture, there are three different facilities that target different types of companies. There's the corporate credit facility, which essentially targets the bond market. So the CCF allowed the US government to buy corporate bonds during 2020. So it's a way to directly support companies that borrow using the bond market and also commercial paper, right, which really is a short-term bond. All of these policies target larger and safer firms. Those are the firms that have access to bond market. For example, Roof's Hospitality Group does not issue bonds, but companies like GM and Ford and Delta Airlines, etc., who were in that other picture, do have access to bond market. So because not all companies have access to bond markets, the U.S. government also created other ways to support the debt market. So there is this alternative, additional policy called the Main Street Lending Facility, which is a way to support bank lending. Through the Main Street allows the U.S. government to buy participation in loans that are originated by lenders. In this case, the lender has to retain a percentage of the loan. Essentially, the government is using the banks to screen and monitor loans, but the government is providing most of the funding for these bank loans. And these Main Street loans are available for smaller companies. Those are the companies that typically have to rely on bank loans for their financing rather than bond markets. So fewer than 15,000 employees, for example. And then there are some maximum leverage restrictions. So the U.S. government is trying to assure that these are good loans, right? And then finally, there is the PPP, which maybe is the most famous government intervention that's the favorite, it's the one that the financial press likes to talk about the most. And PPP, again, it's a liquidity provision facility. The difference is that PPP is a grant, really. I mean, those are forgivable loans. Companies don't have to pay it back as long as they obey there are some restrictions, right? Essentially, the PPP is a program that was designed to support employment. So in order to have access to these grants that increase liquidity, companies have to commit to keep employees on the payroll, okay? So again, this is done through banks, but here, there's not a lot of concern about repayment and credit risk because these are grants. So the US government is aware that these are probably not going to be paid back. And we don't have all the data yet, but that's what I don't think the government expects these loans to get paid back. Unlike the other ones, right? The bonds that the government is buying may actually be very good investments, as we're going to see in the end. Did it work? Yes. The US government was very successful in restoring liquidity to debt markets. So this is an example of a very successful government intervention. So we can get data from different perspectives to look at this. So, for example, what this graph shows is the amount of corporate bond issuance by investment-grade companies in the US, and you can see here at the end that the beginning of 2020 was a historical period, really. So there is an unprecedented amount of bond issuance by US companies. And this is easy to explain, right? So there was this demand for long-term debt. Companies needed liquidity, and the US government stepped in to support the bond market. So it made it possible for companies to increase liquidity. The prices have also responded. So this is the same chart I've showed you before with the prices for highly leveraged loans. So you can see that there was this drop right in March and April, and then the vertical line here indicates the actual date in which the Fed announced these liquidity provision programs, and you can see that prices of leveraged loans started increasing immediately. So that's another way to look at the evidence. And consistent with what we said in the beginning, the main usage of these loans was to increase cash holding. So that's the precautionary borrowing that I was telling you in the beginning. So Acharya and Stefan call this the dash for cash. So you can see that across the board for all credit ratings, there was a significant increase in the cash to assets ratio in the first quarter of 2020, right? So here at the very end of the graph, you can see that cash to assets ratio are going up. So essentially, companies are going to the market to borrow long-term debt and increase cash holdings. That's precautionary borrowing, right? So that's, to me, that's the story. It's the summary of what happened in the corporate sector during COVID-19, at least in the US. And my understanding from talking to people in other countries is that it's a similar picture in many different places of the world. Basically, what happened is that with the help of the US government and committed credit lines, the US corporate sector issued long-term debt to increase cash holding. So precautionary borrowing with the help of the US government is what it's the story, the corporate finance story of 2020. Okay, so this is history now, right? 2020 is almost over. So the question is, what lies ahead, right? So, and the concern that many economists had this year is essentially that liquidity may not be enough, right? So this liquidity management strategy may not save companies in the long term. The idea, as I explained before, is that when tomorrow comes, right? Tomorrow meaning 2021, 22, cash flows are going to go back up. But what if the high cash flow never comes, right? During 2020, there was a lot of uncertainty about how long the COVID-19 crisis is going to last. I think this uncertainty is not as stark now as I'm going to argue later, but this is a problem, right? Especially because COVID-19 generated a significant increase in corporate leverage, right? So companies responded to COVID-19 by increasing leverage, right? In the expectation that the shock is temporary. But what if the shock is not temporary, right? If the crisis moves into 2021 and later, then the corporate sector might be in trouble, right? So this temporary shock turns into a persistent negative shock to profits. And at the same time, there is an increase in leverage. It's long-term, right? So the debt is doesn't have to be repaid in 2020, but it's going to start coming due in 21, 22. You know, the credit lines typically have maturities of 2, 3, 4 years. So there might be a problem, right? And economists were even concerned that we might have a financial crisis in Main Street, a wave of bankruptcies, for example, that is caused by this persistent, by the persistence of the COVID-19 shock. So how likely it is that this is going to happen? I think the evidence from markets suggests that we are in pretty good shape. That this is probably not, we're probably not going to have a financial crisis in Main Street. And we can get data from stock markets, but let me actually focus on bond markets, right? Let's try to see what the bond markets think about credit risk. If we are concerned about companies not being able to repay debt, we should see it in bond spreads, for example, or in the price of bank loans. And so what I have here is data on spreads between corporate bonds and US Treasuries for different credit ratings. The picture is very similar. Let me actually focus on high yield bonds, which are the riskiest ones, right? So when the crisis started in March, the spread on high yield bonds shot up to more than 10%, right? So that's the liquidity shock I was talking about in the beginning. So it became very difficult, very expensive for companies to borrow if they are junk rated. But since then, it's a monotonic decline, right? 2020, it's basically a reflection of what's been happening in the stock market as well. So bond prices have been going up since March and April. So the spreads of high yield bonds are back. And if you look at here, this is the end of the, you know, the end of the data. The data ends now in November. Essentially, bond spreads are back to what they were before the crisis. So the bond market is telling us that there is no crisis anymore. The crisis is over. The stock market is telling us the same thing. Highly levered loans are telling us the same story. So, you know, you can see here at the end, the price of highly levered loans are essentially back to where they were before the crisis started. So the crisis is over, right? So there's major improvements since March. Credit risk has moved to normal, close to normal, really, like almost normal, for both bonds and bank loans, and for different levels of credit risk. Okay, and of course we know the stock market is at historical highs. So what this data is telling us is that I think there is not a lot of concern anymore that there's going to be a financial crisis in Main Street. It looks much less likely now than in the summer of 2020, where there's still a lot of uncertainty about how long COVID-19 was going to last. Of course, you know, it's a combination of factors here. The public health is very important. So obviously, this optimistic view of the future reflects the fact that, you know, we expect vaccines to come soon, but it's also because of successful government intervention and clever liquidity management, right? So I think we have to give credit to the US government and other governments in the world for intervening in debt markets in the right way, and also companies, right, that use their credit lines, they use their liquidity management policies in a clever, smart way. Okay. Not everybody agrees that we're out of the woods. So, for example, this recent article I saw in the Financial Times, the Bill Ackman is, of course, the famous investor, hedge fund manager that he made a lot of money in the beginning of 2020 by betting that financial markets were not taking COVID-19 risk into account, and he's making the same bet again. So as you can see here, the billionaire says that markets are once again complacent about the impact of the pandemic. So some people are still betting that things could go wrong, and it's this financial market, and I think it's partly because the situation now, at least in the US and Europe, looks very bad, right? So if you look at public health, we are clearly in the middle of a second wave, right? It's probably the worst period. It's at least as bad as March and April in terms of public health, but financial markets are telling us that the crisis is over, right? So, and what Bill Ackman is betting is that there may be a scenario under which we may still have a second wave of the financial crisis, right? We had the first wave, and Bill Ackman is betting that we're going to have a second wave, right? So just to show you briefly here some data on the virus in the US, right? There's clearly two waves here. There was this is the graph showing daily deaths. There was a wave in April and March, right, which was really bad, focused on New York City, as you probably know. And now there is a broad-based increase in the virus prevalence and public health problems. That's what we're calling wave 2, right? But clearly that's not what's happening in financial markets. Financial markets are basically ignoring this wave 2, right? Same thing for prevalence of the virus. Let me just skip that. So wave 1 and wave 2 look very similar on the public health side, but the reaction from financial markets is starkly different, right? So what's going on? Clearly, it's not irrational, right? So it's pretty easy to explain why markets are so optimistic. So as we know, stock prices depend on the future, right? And the expectation now is that markets, even though we are in a very bad fall and winter in the US, we expect the COVID-19 crisis to be over soon, right? Vaccines are coming, the crisis is temporary, so future profit forecasts are optimistic, as I've shown in the beginning. And uncertainty has gone down a lot, right? In March 2020, there was a lot of uncertainty about how long the crisis is going to last, how big is the impact going to be. I think even though the crisis is very bad now, we have a very good understanding of what's going to happen, right? So, and as we know in finance, risk premia are the main drivers of asset prices, really, right? So what we know from asset pricing research is that discount rates are the main determinant of asset pricing. So asset prices. So even though we're in a very bad period, the risk premia has basically gone down to normal. Okay, so that's, I think, a not very controversial explanation of why market prices are high. Of course, things could still go wrong, right? If we have bad news about vaccines, it's looking less and less likely, right? The vaccine, the UK is starting vaccinating. We will start vaccinating people next week. So it's awesome news on the science side. I think this is not going to happen, but who knows, right? And one point that some economists have made in the US is that even though the economy as a whole seems okay, there are some heterogeneous effects, right? So some firms and industries were hit hard. And for example, when we look at small business, right, and specifically certain industries, so we have to be a bit careful that to point out that the stock market is not a summary statistic for the US economy, or the same point for Europe, for European economies as well, right? So, for example, there is this recent article in the Wall Street Journal that is in my reading list too, showing that COVID-19 had very bad effects for small business. So, for example, there is a survey evidence that finds that 42% of small business are at the risk of going out of business by Q4. So, certain industries were also heavily hit. So this chart shows you the yearly increase in bankruptcies. That we definitely haven't had a broad-based financial crisis, but in certain industries like retail, entertainment, restaurants, we've seen a significant increase in corporate bankruptcy, right? So there are still some companies that are suffering. There's some parts of the economy that are suffering. The question for policymakers is whether we should extend support to small firms and have, should the government try to support these parts of the economy that are still hurt, right? And this is a tough question. I don't think there is an agreement about what the government should do. On one hand, some people say it's obvious, right? Small firms are important. They employ a lot of workers. They are, very important for innovation and dynamism in the economy. And then, of course, we have essential industries such as airlines, right, that are government-owned. So in some countries, the government gives support to airlines, period, even if we're out of a crisis, right? But then there are some economists that think that at this point we shouldn't really be supporting the corporate sector anymore, right? We are in a very different situation. We don't have a liquidity problem anymore, right? The financial markets are open. Companies should be able to borrow, right? And then even if we have bankruptcies, right? These bankruptcies may not be necessarily bad for society as a whole. For example, your local restaurant might close, but then once the crisis is over, another restaurant will open up again. It's not clear what is the long-term negative welfare effect, right? And then, of course, there is the concern about zombies, right? If you come from Japan, you probably know the history, right, of the economic history in Japan. Following the real estate crisis, the governments and banks supported firms that maybe should have gone out of business, and this actually created problems for the economy as a whole. So indefinite support may actually be bad. So if you want a good reference on this, is an article by Raghu Rajan in the Financial Times in May 2020. It's cited in my reading list as well. Essentially, what Raghu is telling us in that article is that maybe now what the government should be doing is to support workers rather than extending support to the corporate sector. And as it turns out, recently the Treasury Secretary is still in the Trump government, right? Actually, and is planning to end these liquidity provision programs, which to me makes sense because the data clearly shows that markets are open, right? So companies should be able to borrow. Okay, so my view, I think I line up more with the second view. I'm not sure we need more support for the corporate sector. I want to end here in the last minutes by telling you a little bit about research going forward, right? I think COVID-19 for me was, of course, a tough period for everybody, right? We lost many opportunities. I should be in Korea now, right? I'm here sitting in my desk at home. Fortunately, though, everybody's healthy. My family didn't have any problems, so I can't complain too much. But on the research side, though, it was very exciting because I think COVID-19 was the best practical example of precautionary borrowing and credit line liquidity insurance, which are two ideas that I've been working on for a long time. So this for me was a proof that some of my ideas actually make sense. But we're also thinking about future opportunities, and I think this crisis also shows us what we don't understand so well. So there are three ideas. There are a few ideas I'm going to talk about here in my last minutes. I was mentioning this before, right? So there were lots of drawdowns in 2020, and these drawdowns were concentrated in large public firms. So one interesting question is whether that compromises bank capital, right? So banks are allowing firms to make these drawdowns, but that can have negative consequences for small firms that rely on banks, but maybe don't have long-term credit lines. And there is actually an interesting paper that there is a link here that you can look at, suggesting that this may actually be the case. I think there's going to be more research trying to talk about this possible contamination effect, right? So how does liquidity management interact with loan provision? In terms of liquidity management theories, I think what we're missing is a better understanding of dynamics. So the theories that we have now, they focus on what we call three-period models. So you have an initial period, then you have it's a little bit artificial, right? So one question that these theories can't really address is the dynamics of the liquidity management decision. So how much liquidity should companies keep, and how much should you use today? So for example, if a company has a credit line, right, outstanding with a bank, what should you do? Should you draw on the credit line and increase cash? Or maybe should you preserve access, right? Should you wait to borrow to use your credit line in the next 2 months, for example? I think we have very little guidance on the research side about what drives this decision. COVID-19 suggests that companies just ran on their credit lines, but in other situations, the answer might be different, right? So And then, I mean, there might be consequences for future access. So when companies choose to draw on the credit line, what happens to the, right? So at some point, the credit line has to be renegotiated, and what's going to happen at that point, right? So I think these dynamics are going to be interesting, and also on the banking side, right? So banks also have to make dynamic decisions to provide liquidity and to enforce covenant violation, right? So credit line access is contingent on covenant maintenance. So companies have to satisfy certain covenants. And then at some point, the bank has the right to renegotiate access. The credit line contracts have a maturity date, right? And I think we have very limited understanding in the research or in the literature about how banks actually make these dynamic decisions to provide liquidity or not, and to how do they renegotiate access to credit lines. In terms of providing liquidity or not, the important thing to notice is that access to credit lines is contingent on covenant maintenance, right? So companies have to satisfy covenants in order to keep access to credit lines. And in terms of COVID-19, I don't think we know what happened to covenant violations. So did affected firms like Ruth actually violate covenants? It seems hard to believe. So profits went down to zero, right? It seems hard to believe that Ruth didn't violate a covenant. And the interesting question is, how did banks respond, right? So banks can choose whether to restrict access or not. So the fact that a company violated a covenant doesn't mean that access is eliminated. The bank can choose to waive the violation. And I think we don't know exactly what happened. This is an interesting topic for research. One interesting thought here is that covenants, there is some research that I've done in the past suggesting that covenants really are a mechanism to monitor borrower action, right? So if borrowers need liquidity because of poor performance, for example, then the bank that has endogenous causes, then the bank may restrict access. So what this suggests, I think, is that the nature of the shock matters. So I have to go a bit fast here because I'm almost out of time. But if the liquidity shock is exogenous and idiosyncratic, for example, weather shock, then firms should be able to use credit lines irrespective of covenant violations, maybe because the bank understands that the shock is not caused by company behavior. But then there are some problematic shocks, right, that are caused by poor performance. So if the company is doing poorly, but the competitors are not, for example, then maybe companies should not have insurance. Okay, and then there are shocks that are exogenous but carry aggregate risk, right? So all companies were drawing down on credit lines during COVID-19, and one interesting thought, that is my last, I'm wrapping up here, is that bank liquidity really matters in this case, right? The question is whether banks can afford to provide access to insurance for, even though the aggregate shock is exogenous, so there are no concerns about managerial misbehavior, moral hazard, etc. Banks can run out of funds, right? And here, what I think might have happened during COVID-19 is that banks were in a strong financial position when COVID-19 hit. So there is some evidence that liquidity, bank capital, bank liquidity were fine. And perhaps that's what explains how banks reacted to COVID-19. Maybe even if companies violated covenant, banks were able to provide liquidity because they had sufficient funds to honor their commitments. So just a last thought here, right? So, we're moving from one crisis to the next. Hopefully this new crisis is over. But what I think might have happened is that the response to the previous financial crisis, right? The increasing financial regulation, the increasing bank capital. So banks were shoring up their capital and liquidity following the mortgage crisis. So that may have shaped the economy's recovery, right, from COVID-19. That allowed banks to provide access to credit lines. It allowed banks to make loans, and perhaps made the economy's recovery quicker than it would have been if banks were in a more precarious liquidity position, right? So this is, like I said, I mean, these are speculations. I don't think we have all the research to fill up the gaps, but some of this research might come in the next few years. Maybe I'll be writing more papers on this, or maybe some of you will be writing papers on this. So thank you very much. I have here, like I said, a reading list. There are some papers. There is a webinar by Jeremy Stein. There's newspaper articles. So many different things to read if you're interested in this topic. Thank you very much. Let me stop here, and we're going to move on to questions now. Thank you very much. Stop here, and we're going to move on to questions now. Thank you very much.
All right, thank you very much. Let's give him a great applause. Thank you. Thank you very much, Heitor, for a greatly insightful speech. Now, let us open the questions to the floor. So if you have some questions, if you are in a Zoom, you can write down your question and share it over here in your chatting window. And on the floor, you can have your microphone. Yes, Professor Inmu Lee is asking questions this time. Great.
Hi, Heitor. This is Inmu Lee at KAIST. Thank you very much for camera. Okay. Hi. So regarding your last point about 2007-9 versus this time, I think yes, it's right that the government was much more aggressive in responding. Probably that's the result of the learning. But at the same time, the nature of the shock is quite different, right? So, this time, a lot of people kind of, safely assume that this was like very exogenous kind of, short term, even though, the period is much longer than we expected in March. But still, it was kind of very exogenous shock. And as you pointed out, financial institutions were, weren't the cause of the problem. But in 2007 and 9, they were in trouble, right? So in terms of the uncertainties, it was much greater, and also it's more fundamental than the cause of the shock this time. So I wonder, similar behavior would have worked in 2007 to 9. I mean, it would have been much more difficult to issue bonds and also increased or have new line of credit during 2007 to 9 period, because financial institutions themselves were in trouble, right? Whereas this time, as you pointed out, they were in good shape, and a lot of people thought that this is a short term. That's why it was easier for them to extend with a more aggressive government response. So how to kind of compare what happened in 2007 versus what happened this time in that aspect?
Yeah. Do you want me to respond now or get more questions? Either way.
As you wish.
Response?
Please, you can
Okay.
do it right now, please. Yes, please.
Yeah. All right. That's easy. I remember. It's getting late here. But it's still 9:40 p.m., so I should be okay. Thank you. Yeah, this is a great question. I think there are 2 points here. The first one, as you mentioned, is that with the COVID-19, there is no concern about moral hazard, right, on the corporate side or the banking side. I mean, the government understands that COVID-19 is not caused by bad corporate behavior, right? I mean, there are some economists who are complaining that maybe companies should have had more cash, right? They should have had more liquidity, but I'm not sure this is fair, right? I mean, no one really expected a crisis like that, and so I think your point, this is on the moral hazard side. I think it's a very different crisis. So that probably the governments around the world felt much more comfortable, like shoring up the corporate sector, because there is no concern that this is going to create moral hazard going forward. I mean, in 2007, 2009, as we know from all the great documentaries, right? That there were lots of, the U.S. government was very concerned about providing support to the banking sector because the banking sector created the crisis itself, right? But then in the end, they had to support the banking sector anyway because, you know, I mean, the economy was going to tank, right? So, yeah, it's a very different crisis. I think in terms of the policies, the policies are very different also, right? So I didn't talk much about what the government did in 2007, 2009, but there, the policies were mostly to support the banking sector directly, right? There wasn't really a concern with corporate liquidity, I think. The evidence suggests there is a, you know, there is some research by Amit, not Amit Seru, Amir Sufi, and for example, showing that it's not really a crisis of corporate liquidity. You know, 2007, 2009, companies were only indirectly affected. So, whereas in this case, really the priority was to support, you know, to support corporations directly. So I think that's a very important difference, you know, and we see it in policies all over the world, not only the US, in many parts of the world, you see like governments really shoring up corporate liquidity directly and supporting small companies and everything. So I think that's the distinction is very clear. Yeah. Thank you.
Right, thank you.
Yeah.
I have another question by, right.
So, Hito, this is Woo Jin from Seoul National University. It's too bad that we can't really have you here physically. But my question is actually related with Inmu's previous question. So you just mentioned that the way that government supported with the market was a bit different, right? So in the last crisis, it was the support was through the banking sector. And the only exception that I remember is like General Motors, where the government directly put in government money to the corporate sector. But how is it different in this case? Are the government, U.S. government actually putting in money to the corporate sector directly? And in that case, how do they select which ones to support? Like, is there any problem of which ones are supported or not? And then what is your view on the current U.S. government's position, so on?
Yeah, no, great question. I mean, I didn't have much time to talk about the policies in detail, but there's basically three policies, and they're essentially indiscriminate. So any company can have access to these liquidity. Is lending money directly to companies that can access the bond market. And there is no selection. In the beginning, the government restricted the program to investment grade companies, but then it was extended to high yield, to junk rated firms as well. And then Main Street, there is some selection, but the idea is to do the selection through banks. So the way that the program is structured is that the government provides liquidity to banks, and then the banks have to make the loans and keep a stake in the loan. So the bank has to have you know, skin in the game to make sure that the bank is selecting good companies. And then finally, there is the PPP, and I think PPP is just available for everybody. In fact, you know, I didn't have time to talk about this as well. There is a lot of financial press concerns that some of the PPP money went to companies that should not have received funding. You know, so, but I mean, I agree this may be the case, but my view is the big picture is the government intervention was successful. I mean, we're so, one problem I have these days in the US, there's so much pessimism about everything, you know, like all the complaining about, you know, things that are going on and the economy is bad. So, you know, sometimes there is no room for actually pointing out good things, you know. So maybe even the Trump government did something reasonable, right? So, which was to, you know, support the debt market in this way that I think really helped the economy overcome COVID-19 crisis. So I think it's important to point out the positive side of it as well. But yeah, there are some concerns. especially with the PPP, you know, it's grants, right? So the government is basically giving money to companies. And there is some concern that some money was wasted. But the way I see it, I think this is a secondary point, you know, relative to the positive impact that these liquidity provision programs had in the economy. And as the first speaker said, there is no moral hazard concern. So I don't think we can say that the government should not have supported companies. But companies didn't create the virus, right? So I think I have a much more optimistic, positive view of the government intervention than what many people here have.
Clarify. So for the first and the third program, there was no limit. As long as the corporates were wanting to borrow, the governments were backing up, unlimited.
Yeah.
Okay.
Yes. Yeah.
Thank you.
Thank you. Any other questions, please? And in the floor, you can write down your questions and then give it to our staff member.
Yeah, there are some questions on chat. Do you want me to read directly, or does somebody read?
Maybe I could.
It's up to you.
Maybe I could read it for you. All right.
Okay. Yeah. Fine.
All right. So, dear Professor Almeida, this is Srinivasan from Peking University. I have a question. Do you think the crisis and the response is going to worsen income inequality, providing stronger support to corporates beyond the support of individuals who lost jobs during the crisis? Right?
Yeah, no, inequality is an important concern. I think it's part of the reason why, of course, I didn't have time to talk about everything, but if you remember, towards the end of my talk, I was talking about what should the government do now, right? And there is this idea that maybe now it's the time to support people directly, right? Rather than trying to support people through corporations. So, I think the US government should consider extending support, like the stimulus checks to people to support demand and just to allow people to cope with the crisis, rather than providing liquidity to corporations. Whether the actual policies in 2020 worsen inequality or not, that I'm not sure. I don't think there is a clear answer to that. But I do agree with you that if the government keeps focusing only on the corporate sector, then then I think it could become a problem. Maybe it's the time to focus more on people, but in the US, in Europe, and in the parts of the world that are still suffering a lot with the, in some places in Asia also, right? Even though Asia is doing better, but parts of the world that are suffering with the virus, I think maybe the time to support people directly rather than support corporations. I agree with that overall view. Yeah.
All right, thank you. You're very popular today. We have some more questions, but in the interest of time, in the interest of time, we have to cut into one question last, which is Taehyun Kim. You had a question, so you raised your hand, right? So please go ahead.
Thank you. I just typed in, and it's not really a question probably, but I just wanted to ask that these days equity market is really booming, and one thing is that I wonder whether we have seen some sort of equity issuance booming, like was in bond issuance. And second thing is that maybe the idea that appeared in your JF paper about the insurance that was provided by the banks, especially when it's about the systematic risk. And these days, equity market is booming, but the bank stocks are really not recovering. Of course, it's about the very low interest rate, that the bank's profitability is low, but still it could be about the buffer that they're providing to the system and the credit line provision. And I just wanted to hear some thoughts about thoughts.
I think this is a good thought. This is what I was. It's related to this idea I was talking about, the contamination effect that the government was concerned about, right? That banks were providing liquidity through credit lines, but this might be hurting banks' liquidity provision. So it's related to and I think by and large, and also based on others' research, like Viral and Acharya has a paper looking at that. Apparently, what happened during this year is, as I said at the end, banks were in a very strong liquidity position. So it seems to be the case that, at least for the shock in March and April, banks were able to provide that liquidity without creating systematic risk in the banking sector. So I wasn't aware that bank stocks are not recovering. That's an interesting observation, actually. I was under the impression that banks were doing fine, but I have to check that. I haven't seen that. But my impression is that banks were in a reasonable position this time, to provide liquidity to the corporate sector. So I mean, hopefully, our concerns with aggregate risk were not super important this year, I think. So.
All right. Thank you very much for your answers. And then again, thank you for giving very intriguing questions. And this is, I think this is the end of the keynote speech. And we hope you enjoyed our lunch and then the rest of the conference today. And again, Heitor, thank you very much for joining us here. Right.
Thank you. Thanks everybody for attending. Yeah, it's a pleasure. Thank you. Bye.
Later.